Can everybody hear me? Open nose. Can you hear me? All right. Well, I'll assume you guys can hear me and more people can trickle in as they usually do. This is the second time I have been doing these live streams. So once a quarter, I'll do them every March, June, September, and December. The last time I did it was back in September. So just open mic, essentially, ask your questions, whatever you want it to be. I know I did one of these in the evening on a weekday, and we certainly had many people start rolling in for that. So I'm currently off work right now, so it's a little bit better for me to just kind of do it earlier in the day. Anyways, if no one's gonna ask any questions or whatever, what I'll do is I'll just get right to the point of the biggest news of the day, which is Harvest ETFs just launched a bunch of new single stock ETFs. So I have one of the, this is just from Business Wire that I can read off of. So we'll just start with this news and then we can just get to your guys' questions. So the single stocks that they are now going to be releasing to be part of their the high income shares ETF series is MicroStrategies, Coinbase, Palantir, TSLY, METE, and an all-in-one fund to combine all those single stock ETFs. What's really interesting, I think, about this launch with SIX is, unlike the prior launch, to kickstart the series, you had I believe, what was it? You had 4 single stock ETFs. You had also 4 USD versions of them. Then you had another 4 leverage versions of those, and then I think another 4 leveraged USD versions, right? So you had 16 funds. It was really just 4 with just a different spin on it, either with the leverage or the USD. In this case, what we're getting though is not that. So I'm sure, as many of us are aware, I'm sure Adriano from Passive Income Investing, he'll get Michael Kovacs, the CEO of Harvest, on. I'm sure in short order and ask some questions. So maybe I'll forward, Adriano some questions to ask, albeit I'm sure he's probably thinking of these questions already, which is the 6 funds that they're releasing, 2 of them are unleveraged, MicroStrategies and Coinbase, while Palantir, TSLY, and METE have about 25% leverage on them. So it's not like they're releasing, 3 different versions of each of these stocks, right? So we get 5 single stock ETFs, and then we get sort of an all-in-one that's going to combine all of those single stock ETFs. But to me, I'm already wondering, if there's 3 single stock ETFs with leverage that do not have an unleveraged version, are we going to get an all-in-one which is leveraged, HHIS? So that's going to be leveraged. So then Palantir, TSLY, and METE inside of that are also leveraged. Anyway, so I think there's a few things just to I would just wait and see, and wait for that that interview. I'm sure that Adriano will have with Michael Kovacs from Harvest. But exciting times. One of my initial thoughts, again, with this launch was they're really eating into the purpose investments. I guess I want to say their maybe what they've been known for in Canada, right? They've had single stock ETFs for a long time. They've also been a pioneer with cryptocurrency cover call ETFs. To me, they've always kind of come across as a bit of a niche fund provider for cover call ETFs, and that's what I like about them. They stand out. They do their own thing, and they easily separate themselves from the crowd in that way. But I think that conversation around purpose is, in my mind, it's quickly changing, only because Harvest has come right in and really eaten into that, what purpose is known for, especially with all these single stock ETFs. They're no doubt gonna come out with more, and I believe Harvest has, they got the drive, they seem to have the hunger to really innovate in that single stock ETF space with that what was it called again? The Harvest High Income Shares ETF series. So anyway, that's the big news of today. For those in the comments, is this news to you guys, like hearing it from me, or did most of you already know that this stuff was already dropping today? By the way, hello, Samer. Welcome to the chat. Yeah, it's great times to be an income investor here in Canada, especially in the US as well, with the tremendous choices. I've had certainly a few comments from people that live in Europe, whether it's by email or just in the comments section. People wondering how that they can get involved or how they can invest in some of this stuff themselves. And I guess some of the choices are just a little, they're pretty limited on that side of things. They don't really have access to, I guess, the Canadian market. I'm sure the American market is probably wide open, but as most of you know, a lot of the Canadian stuff is you get very consistent monthly distributions that are not fixed. Or I should say, sorry, they are fixed. A lot of them are fixed. So you get, the same amount every single month. Whereas, in the US, more variability. In some cases, you get funds that are really close. Their distributions come out, they get distributed in a very tight, narrow band, but there's still minor variability there. Dividend Shark entered the chat. Welcome, my friend. Another good rate cut today. Maybe that helps with the leverage funds too. Absolutely, yeah. Here in Canada, we saw another 50 basis point rate cut. That's certainly gonna help out mortgage payments. That's for sure. Yeah, that's right. One of the big knocks on cover call ETFs, especially the leverage funds, is the MER, right? The management expense ratio, which is just the total cost of running a fund, not just the management expense fee, right? So this would include things like leverage costs, trading fees, marketing costs as well. It's the all-in custodial costs of operating these funds. I suspect, I would say if we look at the 2023 tax year, which obviously you can take a look at that tab if you've seen the cover call ETF All-Star Tracker. There's a tax tab. You can go through. Not the tax tab. Right on the main Canadian tab, there's a section that compares the MERs from 2022 to 2023. The leverage costs. For a lot of the all-in-one funds, you're looking at about 2.5%. I think BMAX was up there with like 3% all in. If there's ever a knock about the cost of cover call ETFs, it's the leverage funds that kind of get the scrutiny, because it is just so much higher than the usual cover call ETFs. That if it's unleveraged, you might see a management fee of, let's call it 65 basis points on average. Maybe with the all-in costs, you're looking at, 10 to 20 more basis points, maybe. So yeah, the leverage definitely, I think, with these rate cuts heading into 2025, that tax year, looking back on 2024, we're certainly going to see, hopefully, some side-by-side comparisons of just how much some of these costs have come down, which I'll include in the tracker. And even if you've never looked at it yourself, I'll definitely do videos on that. I did a full series of taxes this past April. I plan to do the exact same, just with updating. That's going to be one of the big updates. It will basically be every April, as long as I'm doing the tracker and the channel. April is going to be the month where a new tax tab will come in, and we'll be able to do some side-by-side comparisons. So that should be fun. Okay, so John just entered the chat. What is your guess when the new single stocks will be available? You know what? I just had it open here. I bet it's going to be pretty fast, probably by the end of the month, I would imagine. I mean, the high speculation there. I don't know for sure, because I believe it doesn't say in the announcement, but I would imagine in short order here. And then the question is, with these single stock ETFs, are most of you going to be investing in more of these single stock ETFs now that Harvest has come out with them? Will you prefer the single stock ETFs themselves, or would you prefer HHIS, which is obviously the all-in-one version of those single stock ETFs? So curious to see what most of you will have to say in on that regard. But yeah, me personally, I don't because it's so new. I was just before the live stream here, I was trying to figure out, like, what would I do. I'm all for diversified funds. Even if it's a combination of single stock ETFs, that's fine with me. I'd love to have a little piece of that in the portfolio. I think, but in my opinion, my TFSA is it's starting to get a little bit crowded now. I think I've hit just the right spot with like 6 funds. I got HDIF, which is Harvest's other all-in-one ETF, which basically combines all of their other sector-specific funds. Obviously HYLD, HDIV by Hamilton, right? HYLD, exposure to the American market, kind of the S&P 500 style, whereas HDIV more geared towards the Canadian market. EQCL is kind of my dark horse favorite. It's just, I watch that AUM like crazy. Of any fund that I like, the AUM I watch, it's like that one I watch the most, because I had bought it at such a low AUM. It was like maybe 10 to 11 million dollars, and that's pretty low. But since then, it's actually been growing pretty healthily. On average, I want to say 20% every single month. The odd 13%. I think there's been, since I bought it, maybe 1% growth month over month. But ever since then, it's been mostly pretty big. Obviously, I recently added QQQY just to have a tax sector specific fund. And BMAX, I also have that in my portfolio as well. So adding another fund, I just don't know if I really want to do that. So the verdict's still out. I don't know how I want to play it. Would I replace it with HDIV? I don't think so. Or do I split it? I mean, HDIV is already 10% of my TFSA. I don't know if I want to chop it in half just to go after HHIS. So that's something I got to ponder on. All right, let's go back to the chat, see what some of these questions are. Astrovid, I prefer the diversified funds myself, given my risk tolerance. Hey, fair point. Same here, man. That's what makes it hard with that question now. in regards to HDIF and HHIS. One is all-in-one for single stock ETFs. The other one is the all-in-one for sector-specific funds. And I really like HDIV, and it's been in my portfolio now for a while. I like its performance, and I don't know if I just want to split it up. So I'm going to kind of battle with that for a while. I don't know. Maybe I put a small portion of HHIS in like a taxable account when the time comes. John, you say I don't gamble with crypto. Same here. My opinion on crypto really has not changed much. I mean, if you just watched, we didn't really talk about crypto, me and Adriano, in the video I had just put out, which is just the look ahead to next year, the year in review with cover call ETFs. But in the first year, Adriano had asked me about crypto and what do I think about crypto cover call ETFs. And my opinion has not changed on it. And it's two opinions. One is Bitcoin as a use case is actually really brilliant. And if we go for it, I would love it. If we actually went for it, I think one of the big things that it provides is scarcity. I think it would change behavior in a heartbeat. I think government waste it disappears overnight, or at least not 100%, but let's call it 25% waste gone in a heartbeat. Why? It's because now you're going to have different departments competing for a scarce resource, and competing for a scarce resource changes behaviors very quickly. That's what I would suspect if we were on some kind of Bitcoin standard. And I really actually like the idea of that. But so far, that's not the case. I can live without Bitcoin in my life. I don't have there's nothing in my life currently that I'm like, I need electricity, so I invest in utilities. I need gas to fill up my car, so I invest in energy companies. I use the banks, so I invest in those, right? I know this is we're talking investing 101 type stuff here, but I like to invest in stuff I actually use. I don't currently use Bitcoin, so I have no reason to invest in it. So great concept. And I'm sure people are going to make a boatload of money off of it. It'll go to the moon. Who knows, $1 million per Bitcoin, what have you. But it's not my thing until we start using it. And I haven't felt any regrets about not investing into it. Like, I know my strategy very well. I'm very comfortable with it. And, hopefully most of you are as well with the things you're invested in. There's very little wavering with your investments or uncertainty, or you're confident when you're investing. I'm confident in my strategy. I'm confident in what the things I don't like to invest in, and I'm very confident in things I do like to invest in. And it keeps things very simple, and I just dollar cost average. Let's see. Let's go back to the chat. Let's see. Samer, the cover call strategy is the same as yield max. Yeah, even so with the Harvest funds, they're even stealing some of the names. Wow, it's not. Stealing is in quotations because they're able to copy them because one's on the Toronto Stock Exchange. The yield max, things like TSLY and CONY and MSTY, those are on the New York Stock Exchange. So yeah, sometimes there's overlap that way, but that's okay. Like, there's an HYLD on the American Stock Exchange. It's like a healthcare company of sorts. So yeah, overlap happens. So it's no big deal. But is it the exact same as yield max? I don't know if Harvest is going to be. I don't know if they're really going to go for the insane 80%, 120%. Like, my goodness, some of those yields are just like earth-shattering. I think. I mean, the verdict. We'll see. It'll be a fun story to cover, but maybe in the 20 to 30% range. I think Harvest. I think probably doesn't mind kind of testing the waters in there, and I think on the Canadian marketplace, that the 20 to 30% range is really untested territory. but I think you're going to get there with many of these single stock ETFs. John asks, the advantage for sector specific is to load when one sector is low, getting better return over an all-in-one. Yeah, sure. You can certainly play it that way if you know what you're doing and you want to play the sector short-term plays, and you know how to do that, and you're really, let's just put it this way, you're really interested in macroeconomics. You have a good pulse on just the rhythms of the market, and you've seen it kind of cycle after cycle after cycle. I think playing sector specific funds, nothing wrong with that. I personally want to just keep it simple. So for me, all-in-ones, dollar cost average, you can't get much more simpler than that. It's really almost more of a, buy and hold index style. Like it's much more closer to the buy and hold the S&P 500 style of investing, even though it's just done with cover calls on my end. There are some sector funds I will buy, mainly because I feel like here in Canada, there are a few sectors that you almost like can't go without, right? Banking, energy, and utilities. Those are the big three here in Canada. And the nice thing is that they're big yield providers as well. I think in a interview that Adriano had with Raj, the CEO of Evolve, Raj called it the home bias towards a few sectors. I think he's absolutely right when it comes to that. Even if you didn't maybe know what to call it, I think it's exactly that. Utilities, banking, energy, those are the love of Canadians for dividends, and especially high income investors. So I'll buy into those sectors and I'll just hold them. I'm not going to play them for the short term. Once I'm ready to invest in a taxable account, then I'll be investing in those. But it's great that we have these options that you can even play the sectors for high income. Project Overlord, how's it going, my friend? Thanks for your continued support. I know you're a big advocate of the channel, and you often participate in the comments, so it's much appreciated. Really, I thank all of you guys for just coming in here and hanging out and just chatting about cover call ETFs, and then having your opinion. Like, I do think sometimes I mention your guys' comments. Funny enough, Dividend Shark left a comment one time. I thought it was an excellent comment. It was about house rentals, but it was such a good comment. I was given a speech in front of 30 entrepreneurs at an event just locally to where I live, and I actually had quoted you, Dividend Shark, not by like YouTube name, but I just had one of my, somebody on my channel had commented on this, and it had to do with rentals. There's a few realtors in the audience, so I don't know if they were all that thrilled, me advocating for, just take the equity in your home and invest it in the markets, and then, just go towards a rental. Because as I've shown the numbers before, your money weirdly can go pretty far. You can get things you never thought you might be able to get. Like for me and my wife, getting a house, like, boy, that dream disappeared a long time ago, but now it's been reignited. Maybe not in the home ownership aspect, but in the rental aspect through cover call ETFs supporting that, or the offset of the cost. And I've been keeping a tally of average square footage in like, anything from the $3,500 range to the, sorry, Project Overlord. I got a little bit sidetracked there. I'll get to your comment in a moment here. But what I figured is, and I think one of the last portfolio overviews I did is I broke down the cost of square footage in something that's like $3,500 a month to $4,000 a month versus what you get in the, say, $1,500 a month range. And your money, it goes way farther, way farther per square footage. It was like, I want to say it was like $1.42 for something for like a rental house that's like $3,500 to $4,000, and then it was like $2.30 a square foot for something that's, you know, maybe like a basement suite in the $1,500 range, which actually makes sense. More competition at the $1,500 price range versus $3,500 to $4,000. So naturally, people are going to go bonkers hearing that number, $4,000. Wow, that's too much. That's too rich for my blood type stuff. But you know what? Compared on a square footage basis or price per square foot, and your money starts to go way farther the higher you go up, and less competition up at that range. And there always seems to be, you know, plenty of supply on that end. People want to rent out, especially in my neighborhood. People want to rent out that stuff. So anyway, that's a little getting a little sidetracked there. But covered call ETF is going to support that house rental next year. Definitely looking forward to that. So anyway, Project Overlord, thanks for sharing your knowledge and experience with covered call ETFs. Would like a quick video on your monthly performance and holdings. Yeah, for sure. Certain videos, like the overview ones. So those are like one of my like best performing videos. But I don't always like to just make videos just because like yes, you want, as a content creator, you want to do videos that, yes, do well. And you obviously figure out which styles of videos do well. But because I only make one video a week, I don't want to be, you know, shackled to, you know, a monthly series, because that's 25% of my content every single month. So I'm gonna try to do those like once a quarter. And obviously, if you're part of the Patreon, like we do the monthly meetups, the Zoom chats, and usually there's always less than, I always max out 10 people, and there's never, like, we never max it out. So those are always the times I can share, you know, whatever you want. I actually have a tab now, 2 tabs now for my portfolio and all the transactions that occur. So I said before, you know, I've tallied up all my transactions since the start of 2023. And I have something like 350 plus buys to maybe like 30 sells. So like, I'm truly a buy and hold, you know, kind of investor. I do not simply just buy and hold kind of willy-nilly here. If I make changes, it's for what I figure a good reason. All right, let me get a little bit caught up here. How do you prepare for the change in the US government and impact to tariffs on the TSX? Any sector to privilege? Yeah, you know what? Just before the election, I noticed a lot of fun comments, people selling off their portfolios and you know, just waiting to jump back in volatility, just to maybe capture some volatility. Not really sure how it was going to go. I never had the fear nor the inclination that anything major was going to happen one way or the other. I think if Kamala was elected, I think you probably would have seen probably just a stagnation. I mean, who really knows? I mean, I'm just, right, this is total, you know, speculation in hindsight here. I don't think much would have changed. The markets probably just would have kind of petered along. Would it have been a crash? No, I think it just kind of would have meandered along. With Trump coming in, I kind of figured there would probably be some, you know, excitement around that, and we sure have seen it. So, but as far as, you know, what sectors to play, I'm not doing. So far, I'm in the all-in-ones at the moment. So currently, I'm not playing any sector, right? So I'm kind of insulated in a way, and I only have 20% of my portfolio currently exposed to the Canadian market. So especially through like HDIV, I think that's probably my biggest all-in-one that's exposed on that end of things. So next year, maybe midway through the year, I'll pick up some of those sector funds. I mean, a fund like ENCL, picking up that next year, mid next year, oh man, am I looking forward to that. Especially if oil's beaten down pretty good in Canada, like it's gonna, that's the thing with oil. It goes through the boom and bust cycles of love and hate and love and hate. And, you know, oil has traded at the same price over the last 20 years. And I know it's going to be weird to say, it's probably one of the more, dare I say, deflationary products out there. If you just take it from that point perspective, like our dollar was obviously worth a lot more 20 years ago, and on average it's trading at the same price. Maybe you don't feel it at the pump, but sold at a per dollar or sold at a per barrel basis is really just hasn't changed very much. So yeah, I mean, I think ENCL is going to be let Trump kind of do his thing, in office, and we'll see how the aftermath plays out with the tariffs and everything. And he's calling Canada the 51st state, and the great governor Justin Trudeau. It's all. Here's the thing: all of our politicians are getting all bent out of shape. Nothing's going to happen. Honestly, there's nothing to worry about. It's just Trump being Trump. So, that's going to scare the oil barons. But to me, it's like I know I'm going to invest in oil. So to me, it might be good timing, depending when I sell my place, get that money, taxable account, ENCL. Here we come. So I'll probably put. I think I wanted to do maybe 50% between USCL and QQCL for the growth aspect, the other 50% on the taxable side of things, in just a breakdown between ENCL, let's call it for now, bank, and maybe UTES or UTES for now. So whatever that is, let's call it 16%. So 16% of that non-registered account will be probably ENCL. But if the opportunity is like too great to ignore, or the prices are so beaten down, if oil's looking really, especially in Canada, if it's looking abysmal, then I might pick up more. But I know I will invest in oil. It's like Canada and oil go hand in glove together. This is not the end of oil in Canada, and especially if we get a government change. Right, this might be the next 6 to 8 months could be a really opportunistic time to get into the oil sector potentially, but always potentially. All right, catching up here. Let's see. Looking forward to your experiment with the housing cost via cover calls. Wishing you all the best. Yeah, thanks, Project Overlord. Me too. Yeah, the house rental thing, I think that's not going to be like the main source of content next year, but I think that will be a reoccurring theme that certainly many of you have reached out and said, curious to see how that's all going to work. For me, it is too. It's going to be it's almost like owning your home, but seeing the price fluctuate every single day, which you don't really think about when you buy a home. You don't think about, the price fluctuation, but when my equity is coming out of my home and going into, diversified funds, I'm going to be seeing that whiplash every single day. So it will be interesting to put that into action. I do have some buffer contingencies in case something happens to the market. So if distributions get slashed, and if distributions get slashed, where do I make up for that income? Well, I'm obviously going to just contribute less. I usually contribute $1,000 a month. I'll probably use my TFSA as an income buffer. Anything that produces, I might use that also for the house rental as well, depending if how big of a potential correction we see. So these are things behind the scenes I do plan for. My TFSA is just meant to just reinvest, or invest in other things that I think can bring me a return, just like I recently did. I took some money out and I put it into a personal RSP. I think that made the most sense, and I'll get that contribution room back in January. But yeah, stay tuned for that. Dividend Shark, glad to hear. Let's see, glad to hear that. Good to hear from all different perspectives. Cover call ETFs are life-changing for me, taking the grind work out of real estate investing and making more dollars in the markets too. Yeah, I mean, I think we've kind of commented back and forth about that, Dividend Shark. As many of you know, I think you've been following this journey for a while. I too was invested in real estate with my folks from the time I was 18 to the time I was 26. So, putting my money in for house flips, condos, townhouses, houses, did it all. I've like replumbed a whole house, pretty close to where I live. So that was a pretty interesting experience, and it's a lot of work. And I just, I wish I had a bigger interest in it, because I think the interest in finance would have followed it, and I would have had, even more room to work with in my 20s. But I just did not have the investor mindset in my 20s. It wasn't until I almost turned 31 where it finally clicked, and I was like, I should have done this sooner. And anyway, so, but better late than never, I guess. But they're once you read a few things and you get comfortable in your strategy, cover call ETFs are, once you're over that learning curve, you can just kind of set it and let it ride. And you're letting all the fund managers do all the maintenance work for you. And that's one of the best parts, is they're looking after it for you. Astrovid says, the rental use case is really cool. Yeah, me too. Like I said, I do plan to do like a high quality video where, I was telling Adriano that what I want to do is I'll show you guys my current place. How does, a guy married with 3 kids make it work in a 2-bedroom condo, 800 square feet. And then, so basically what I want to do is kind of give you a tour. And it's not like my place is, it's not like it's like ramshackled and it's a mess and we're going from rags to riches type stuff. No, it's a nice renovated place. Like, we bought it renovated. But I want to like open the door and then basically, cut, and then you'll see like the door open up to like basically the house or something. So that's kind of my big, my big ideas of like an unveil of like, okay, cover calls are going to be supporting all this. So it'll be kind of like I don't know, like one of those, you basically get a tour of like my old place and then the new place. So that's one of the things I really want to do for that. And I think once that use case is shown, I think it just gives it a little bit more legitimacy. I can also speak to it like, I didn't see that coming. Now that I'm in this spot, this is kind of like this is what I'm learning along the way. So it's a bit of a learning curve, but like me and my wife are going to do it. I know when I first brought it up to my wife, she really wasn't keen on it, but I think the alternative was, well, this is the alternative. It's not that we can't afford the next step up, which is a townhouse. Like, we can do it, but I'm going to be a slave to my job, and I'm going to need to work as many extra hours as humanly possible. And I don't want to feel that way. I don't want to feel compelled that I'm getting behind on bills, or I want to be free of that. And the only way that I can currently see us being free of that is going this route. So I know it's a bit of an experiment. It's quite the alternative. I've had somebody at work, like I talked to a lot about this and you can tell people, but when it really starts to sink in, I had one person stop me and they're like, it's hitting me of like, and doing a little bit of research. I kind of like where you're going with that, so, and someone who, recently, put a $1.4 million offer on a place. It didn't go through. So I'm not sure if they're happy about that or not, but they were at least open to that point of view. So we'll really see. We'll see how that goes. Neo One. Hi, Jordan. I'm late to the launch party. Better late than never, as I always say. So never too late. Old school house tracks. Hey man, great content. What are your thoughts on buying unhedged dollar versions like USCL versus US hedged versions like HYLD with the Canadian dollar currently? I own both versions of HYLD, so I have HYLD.U in a spousal RSP, and so that fund with the currency has just been a boom. It really has been. It's provided not only extra value on the unit price side of things, but also distributions as well. And I swapped out XYLD last August for HYLD.U, and so I'm going to hold that probably for another roughly around 2 years, and then I'm going to get rid of the spousal RSP. So there's a little bit of a tax maneuver there, just to do with my wife doesn't earn an income, so right now I get the contributor tax credit. So when you're on a higher income, that's obviously great for me. If I wait 3 years, we can start pulling that money out at her income tax level, which is 0. So that's a nice little great maneuver if you're in a particular situation. So if you're married, your wife doesn't, or husband doesn't own or earn an income, you can certainly take advantage of that little process. And again, I'll talk about that once it's fully complete. But that, again, once I reinvest that back into a non-registered, then it'll start just paying off not paying off, but going towards the house rental. But more to your point about what are your thoughts around unhedged dollar versions like USCL versus hedged. I mean, I guess it really depends when you get into it. So, I mean, if you were into, like, say, HYLD, obviously probably better you bought it a year ago. And with USCL, I plan on picking that up probably next year at some point. So I think each one has its unique use cases. If you want, maybe, I guess, a little less volatility, you go for the hedge version with, say, like HYLD. If you don't mind the currency also playing into the price factor, then you go with USCL, I guess. Honestly, like, how do you best play that? I just like indexes and all-in-one. So I don't really think, like, I'm not going to invest in something because one is hedged over the other. I like different strategies with different sectors and different leadership styles, and so I put more of an emphasis on more the fund diversification and what encompasses that diversification with every single fund. And so sometimes that kind of leads to a bit of a Frankenstein mess of diversification with all kinds of wicked overlap. But that I don't mind. And honestly, I don't know. I think HYLD and USCL, I think they're fairly similar. I think HYLD year to date total return wise is beating USCL year to date, but probably not by much. So USCL is just a full-on index, where HYLD is just a combination. Really, it's basically, for what it is, it's SMAX and QMAX, and each of those are stock picked to represent sector makeup of the S&P 500 and makeup of the NASDAQ 100. So yeah, anyway, I'm more interested in the investing strategies, not necessarily the unhedged versus hedge, but each has a use case, and I plan to invest in both. Astrovid, a booming U.S. economy will require Canadian oil. Yeah, I think so. Those guys will get that figured out. Even if there's tariffs, the one thing Trump does not want for his own people is higher prices. They're just coming out of the Biden era with higher prices, and the last thing he wants to be known for is higher prices, and especially if that's going to come off of the back of tariffs. And there's a lot of back and forth about, what good are tariffs, what, it's inflationary. And anyway, there's a lot of just chitter chatter about that in the media. But I think in the end, it's more of a leverage tactic than it is for anything. I think he knows Trudeau's weak. He's basically a lame duck prime minister. He's on his way out. That writing is fully all over the place. That's why Trump can tease Trudeau like he's been doing with the governor talk and the great state of Canada. To me, that's all just like hilarious comedy from a comedian. He is a comedian, And, I mean, certain politicians are getting all bent out of shape about it, but I think in the end, it'll be fine. And yeah, maybe in the short term, Canada, investors will get scared. They'll run away from certain sectors maybe ahead of time. So maybe you'll see volatility and like that'll all spike, I'm sure. Or what do you call that? Like just average trading volume of certain funds just to get out of certain sectors. But Canadian oil, I do not disregard Canadian oil. And if it's trading on the cheap, I'm going to be all over that. But for me, it's just, it really is, it is very much a timing factor because I'm waiting for to sell my home. I can't, even if the prices are rock bottom, it's like, I'd love to get into it, but I just can't do it at the moment. So for me, it's just very dependent on the sale of my place. Neo One, I purchased Utes today. It had a few down days. Great. Yeah. I mean, I think Utes it's going to compete with UMAX. I mean, one's leverage, UMAX is unleveraged. Those are sort of the two big sector-specific utility funds here in Canada, one by Hamilton, one by Evolve. And for me, I envisioned myself always going for UMAX, but as soon as Utes came out, well, now there's a little bit more of a competition. So luckily for me, I get to wait and see how Utes does, and also see how UMAX does as well. I typically like to go for the leverage things. And now the one thing I do like about UMAX, there's one thing about UMAX I do really like. It's got the railroads in there, and Utes does not have that. Now that's not a make or break for me of whether I'd invest in it or not, but I do think like the railroads are I would consider it a pretty vital piece of that, to be in that conversation for utilities. Astrovid, Utes is interesting, but Rogers BC TELUS in it give me pause. Telecom in transition in Canada. Yeah, I've kind of, in my opinion, I think Rogers, Bell, and TELUS probably disappear overnight if the government probably just doesn't protect those industries. If they open it up to the US, they go bye-bye. And I think that writing is pretty well on the wall if that happens. Do they stay insulated the way that they are? I don't know. It's a good question. Having some exposure to telecoms, yes, they're a bit beaten down, but I don't mind a little bit of exposure to it. I think that makes up communications. So I'll take it, whether it's in UMAX or Utes, and hopefully that sector can certainly, or those industries can certainly find a better footing, and hey, we can see share prices rise because of it. Neo One, I'm okay with it going down further. I'm reinvesting each month currently and happy buying more shares at lower prices. Yeah, great attitude. I would as well. I don't think those industries aren't, again, I just don't think they're really going to go anywhere. I think Canada really wants to protect certain industries, whether you want to call that, great for us consumers. I mean, probably not, but our economies with the US are so intertwined that if certain industries aren't protected, like telecoms, I don't really care. They can, whether we get on Verizon or what is that, AT&T, it doesn't matter to me. It's just whatever's the better deal, and for one aspect of cost of living to be slightly reduced. I think in the eyes of most people, they wouldn't care. They would just go for the cheaper option, especially if it offered more. Because get more for less. That's something you don't really see these days. Let's see. We'll go down to. Sorry if I don't say it quite right. Sidhar, I like the IWMW ETF from iShares, covering Russell Index from Cover Calls. Like to know your thoughts or comments about it. The one by iShares, yeah. There's so many cover call funds now and so many launches. It makes it a lot more difficult to have I would say a really educated opinion on just every single fund just off the top of my head, especially on the US side of things, where we see so many indexes from the S&P 500, the NASDAQ 100, the Russell. I think the Russell funds are the ones that are starting to catch up a little bit. You saw many launches of the S&P 500 and NASDAQ 100 for many of these launches over the past 2 years. And anyway, so Russell 2000 funds, they're coming into their own. If I remember correctly, though, small caps, maybe over the last year they've done, I want to say, don't quote me on this, but maybe over the last year or so, they've done really well. But if you extrapolate that out further, it's just a different picture of how well they do. I think they're probably over the last 20 or so years, really since like the tech bubble, we've seen quite the consolidation of companies and companies getting larger, buying out smaller companies. And so I think that trend probably just continues. So, basically what's at the top of the S&P 500 right now, probably, I think the companies that are at the top of the S&P 500 now have a better shot of staying, have a better chance at longevity over the next 50 years than, say, the 50 years prior. Like whatever was at the top of the S&P 500 50 years ago probably isn't there anymore. I can almost guarantee you that. So yeah, I'm kind of cherry picking, just kind of data out of thin air there, but I bet you it's different. So as far as the fund, I can't really speak on the makeup of it. So the only thing I can try to give you some context is on the index itself. I'm not sure if you're going heavy on the Russell 2000 at all. I would say it's probably, if it were me, I wouldn't mind maybe some light exposure to the Russell 2000 just because it's a different index. And who knows what kind of market environments, like where a group of small caps can really rev up and outperform everything else. But you know what? I think over the long term, I think the big boys, like they're going to keep continuing doing their thing. Those are going to be the companies that will continually be added to more and more ETFs, which will boost those prices even further. People will continue to buy into those, top whatever 20 stocks that make up, 30% of the S&P 500. So just food for thought there, Sidar, when it just comes to that. If IWMV total return wise has been checking the boxes on all your goals, all the power to you, that's great. But yeah, food for thought with the Russell 2000. It just got added at RSCC, which is a new global X fund, cover call ETF. On the Canadian side of things, it just got added to EQCL. So it's my first exposure to it. And that's one of the things I like about the all-in-ones is like the fund managers typically like to add the newer funds in there. So, instead of pulling my hair out over, where am I going to add that fund? Like it seems like a good strategy. With the all-in-ones, the fund managers usually just stick that stuff in there anyway. So I always get a little bit of a light exposure no matter what to newer funds getting put into things like EQCL. So I got a little tiny exposure to the Russell 2000, which I'm fine with. That's fine. That's like, there are things that some of these all-in-ones invest in that personally I wouldn't invest in bonds, but like I get a little bit of exposure to BMAX. I really like the structure of BMAX overall, multi-assets. So that I don't mind, even even like HTAE is Invest in MicroStrategies, that right is basically a store for cryptocurrencies. I've already told you guys my opinions on cryptocurrency. I don't mind like light exposure through diversified funds. That's fine with me, but like direct exposure on certain things is I will be a little bit more leery of. Okay, next question by Mirror. Just got an email about Harvest adding 6 new funds. Yeah, that's something we talked about at the top of the live stream. Kind of went through a little bit, but anyway, I'll do a light recap as more people have come into the chat. Basically, you're getting 6 funds, 3 of which are leveraged single stock ETFs, 2 of which are not, which are the Coinbase and the MicroStrategies one. So I guess the volatility on that stuff is so high that they don't need the leverage on those. So really interesting to see how those are gonna, like what the yields on those are gonna be. And then you got the diversified HHIS, which will be the all-in-one for those single stock ETFs. One thing that I said about that, I wouldn't say concern, but it's just how do you work in the fact that unlike Harvest's initial launch, where it was like 4 single stock ETFs, then 4 single stock ETFs with leverage on Eli Lilly, Nvidia, Microsoft, and Amazon. So you got the leverage versions of those 4, you got the USD versions of those, you got the leverage USD versions of it. Anyway, it ended up being 16 funds. Maybe perhaps a little too many to start. And so again, speculation on my end. So that's maybe why they're being a little bit more targeted with the launch with these ones. That's why you're not seeing, basically 4 versions of the exact same thing. You get, what is it? Palantir. I'm going to have to go into what are the 3 companies? Palantir, TSLY, and METE. So those are going to be the leveraged ones, MicroStrategies, Coinbase, unleveraged. And then you're going to get a leveraged diversified fund of the all-in-one ETF. So this is the part that maybe doesn't make as much sense to me, is that it's going to be an all-in-one for these single stock ETFs, but of which ones is it going to be? You're going to have some single stocks in there that are going to be unleveraged, and then you're going to have some that are going to be leveraged if that's the case. So it's a little bit of a head scratcher at first, but I suspect, as I said at the top of the video, Adriana will get Michael Kovacs on, and I'm sure they'll hammer out those details, and it'll become a lot more crystal clear. It's day 1 of this news coming out. Very exciting news, but it's naturally there's going to be questions behind it. Okay, next up, we got Gillis P, also another regular contributor to the channel. So welcome to the live stream. Also looking forward to your condo for cover call rentals. Looking for great results for you. Thinking of doing the same. Yeah, that's obviously been a talking point in this chat of doing the whole supporting using cover call ETFs for rental purposes. I look forward to it too. I want to do it right now, but I strategically have to do it in either the spring or the summer. I've tried to sell my place before, like 5 years ago. And the interesting thing that I realized about it was I tried to sell it in the spring. We were asking a lot of money for it at the time because we needed that for the next step up. So we were just kind of seeing what the hunger was like out there. And if we were to stay, it was no big deal. But we just wanted to see what the appetite would be and what would be, who would bite on it. What we found out is, like, in front of our place, there's a ton of trees, and it gives you a lot of privacy when basically the trees and everything's in bloom. But we had the whole thing on the market for like 10 months. So we pretty much went through every season with it. So there was one comment we started getting as the leaves started to fall off the trees, and people were like, "Oh, this isn't very private." And that comment started to come up again and again when the trees were not in bloom. So for me, that was a clear signal that, okay, I basically have not 10 months to sell my place. I have maybe a 3 to 4 month window to try and sell my place so I don't get those comments again, as I'm sure that they were brought up. Now, the reason for that is because it faces a main street, and there is like an empty lot in front of my place. So there might be construction there eventually. There's like it's like half owned by the city, half owned by some private investor who lives in a far-flung country, and he's just holding on to the land. I know it's frustrating the city because they've had plans to they want to build on this plot of land for the last 10 years, and this guy's just not given up that section of land. And so yeah, the city and this private ownership group or whoever owns the land, there's been no mediation over the years, and at this rate I just figured nothing will happen. I first discovered it in 2018, and 6 years have gone on, and nothing's happened. Gary L, like those ETFs that track underlying tracking underlying performance and will increase payout after price hikes, such as purposes. Like those ETFs that are tracking underlying performance and will increase payout after price hikes, such as purpose. Sorry, Gary, I'm not exactly sure what you're asking there. So I'll do my best to try to sort of fill in the blanks. But if you are, I guess, if you're invested in funds, maybe you're waiting for a dip in the market just to buy more. Just keep in mind that as long as markets are rising and AUMs of these funds are rising as well, there's a much better shot your distributions are going to increase because of it. The reason for that is, especially here in Canada, we have, let's say, a bunch of fund providers that, write up to 30% of the fund for cover call writing. As the fund's value goes up, well, now the percentage on that writing starts to decrease. So essentially, they're getting the same dollar per distribution, but the yield is going down in conjunction with that value going up. So they're able to write more to stay within the guardrails of, say, the prospectus, which if it's 30%, maybe they want to write a little bit closer on a higher value. And so because of that, your distributions can rise, which means a higher yield based on your current unit price or your average price that you bought it for. Hey, and if things decrease, maybe, albeit I doubt these fund managers really want to cut, although they don't have to keep it the same, but I have a strong suspicion they'll do whatever they can to not cut. This is actually a conversation I've had with Michael Kovacs of Harvest ETFs. He was at a Blossom event in Vancouver, so I got to have a long, lengthy talk with him about harvest strategies. And it's great to be able to talk to those kinds of people because you can really feel the energy and the passion that they have for what they're doing for Canadians. And I certainly got that vibe from Michael Kovacs. And I think one of the big takeaways I took from him is because they don't raise distributions often, I know that they just did that with funds like HTA, HTAE, I believe Huddle and Hubble, maybe. There was 4 to 6 funds in there that they recently raised their distributions on. But the way he made it sound to me is he's like, look, we don't just raise them just because an investor says so. Maybe the investors think that, but ultimately we want to be able to preserve these predictable payouts. That's what matters most to our investors who invest in our products. And so he was saying how, even he told me initially, he's like, even if the market was able to drop by 30%, he's like, we are in a position where we can maintain that distribution. And then, you know what? It was interesting. He paused. He's like, and he thought about it. He's like, you know what? maybe even 50%. And he was thinking about it. You could tell he didn't want to just say the wrong number. And so it was again, it was kind of cool to see that if it actually happens and we see a crash or something, I mean, that is gonna be the biggest pressure on cover call ETFs is look at them go down, look at the distributions, if they get cut or maybe they don't. In 2022, there obviously wasn't the same kinds of funds out as we see now. So the next time round, it will be interesting, but I think 2022 is probably it's the nearest case study we have, and how many funds actually dropped their distributions. That might be worth a video to explore that, and I can get that data from the Cover Call ETF All-Star Tracker and just go through the funds that actually cut it or they didn't. So again, curious to see what the math is there. But I think, you know what, I might write that down and maybe do a video on that in the near future, just maybe to put some minds at ease when it comes to that. Yeah, no, I agree, John. I think, as we're talking it out here, it's, some things like just come naturally like that. Like let's just do a case study and see how these funds actually hold up. Like, yes, I've heard from a fund manager personally, and yes, I've heard them in interviews that, the distribution is safe, but man, when push comes to shove, it's obviously different when the pressure's on to truly maintain it versus like what else is going on in the market. And those are the scenarios I really only care about at the end of the day, is what is actually happening out there and how are you actually reacting to it, not just saying words just to maybe appease investor sentiment. But you know what, it does give us clues into how certain funds operate. And anyway, all I'll say is Michael Kovacs was a great wealth of knowledge, and I really enjoyed my conversation with him at the Blossom event. Hopefully more of these fund managers come out to these Blossom events in Vancouver, because I'll be first in line to talk with them about just whatever's under the sun. One thing I didn't realize is actually Harvest, they have representatives out here. So I met some of them at that Blossom event, and I guess they do networking stuff out here, meet with clients out here. I don't know whether it's retail or what did they tell me? You know what? I don't want to speak for them, but let's just say they're definitely speaking to big clients out here, and I try to pick up some Harvest funds, and not a bad idea. Harvest is a solid fund provider. You know what? Now that we're running on an hour and 8 minutes here, if there's any last remaining questions, maybe I'll take a couple. Other than that, I'll sign out for this live stream. So if you guys have anything else, just throw it down below, and then we'll get out of here. So I don't know. It doesn't look like there's anything else. So as always, everybody, appreciate the support for the channel. It's a pleasure to obviously get to share my experiences with all of you in this regard. Happy to do so. It's a lot of work goes into this channel, especially with full-time work. I mean, I kid you not, probably upwards of, on average, 50 plus hours a week. I spend 15 hours for my drive every week. You throw, family into that, kids and their various activities, and throw a channel onto that. And, it can be, obviously life is full, but man, it's rewarding. Keep coming back week after week. That's how I know I really enjoy what I do here, with being able to share my experiences with these funds, and just trying to help you guys make better informed decisions, help with everyone's confidence. It's been wild. You guys have been really supportive. There's, to my surprise, there's very little. I'll just say hate towards the channel. Very little of that. Now, maybe as the channel grows, it's proportional to how big you get. Well, what I find is, because this is such a niche kind of finance channel, the people who are coming into this really do want to learn, and they're not here to just be a troll, and you guys are just not wasting your time. That's not, I can see it in my analytics. You guys are not those people. You do want to learn. You do want to make better decisions about investing, even if it is to become an income investor, or it is to, get a little bit, have a bigger slice of that income pie for yourselves. And I think I'm also pretty open with the channel, how my investments are doing. Ultimately, that's all it's ever been about, is just see how this strategy is. If you're investing 100% in covered call ETFs, what does it look like? What is that experience like? And I think there's only so much you can get from talking with, a financial planner, advisor, maybe on the topic of covered call ETFs. They might maybe only be able to give you sort of the broad-based parameters of what a covered call is and how it can work, and how maybe if you're retired, you can use it for income. And I'm not saying that those opinions are useless or anything. I think all those people have a place for your goals and what you're trying to achieve at your income or your ages, levels of risk tolerance. It's personal finance is quite the journey. And, but, investing in this stuff for a long period of time opens up a new world of being able how to speak to these funds from experience. And there's nothing quite like, just getting into the trenches of really anything, and just see how it goes. And 2024 really surprised me. My total return for the portfolio this year has been beating everything. I did not expect that. I mean, I'll still say that in the long term, I don't think it'll continue that way. I don't think it will, but I can't believe that the portfolio has done as well as it has. And, credit to the fund managers for, constructing funds in such ways that, they just keep making them better and better. And, so props to them. And keep investing, guys. Don't stop. And no FOMO. Fear of missing out. So Astrovid, everybody's saying thanks. We appreciate your content. Thanks, Jordan. Sometimes being all in on covered call ETFs is scary, but usually not. Yeah, I mean, I don't know. I've become, I'm so entrenched in my own strategy and my own goals. And I think once you come to a place where you're really locked into what you want out of your investments. I mean, that's a big thing. Once you have a destination for your investments and you attune your goals to that, and you attune your investing strategy to that, and when you're really locked into that, I find it has made the experience of investing so much easier. And, I just really like covered call ETFs. They're, it's just an overlay on something that most finance YouTube channels talk about anyway. Low cost index funds, invest in them for your life. Okay, well, throw something like a covered call. Covered calls have been around for decades and decades, probably a century they've been around for, and they're not going anywhere. So package them into an ETF. It sounds brand new, but I mean, invest, covered calls been around for a long time. ETFs been around for a long time. Smush them together. It's just putting an old spin. It's putting a new spin on something that's not new. I guess I should put it to that way. All right. Last thanks everyone for stopping by, and I'll see you all in the next video.